Diversification is protection against ignorance, Buffett once remarked. It makes little sense if you know what you're doing. This quote often circulates among investors, investing forums and social media, particularly among those who are young, new to investing and exude confidence. For them, the meaning of Buffett's words is crystal clear. They choose to manage concentrated portfolios, believing this strategy is their path to wealth. Maybe only one or two stocks they are extremely confident about, thinking that it will make them more likely to make them rich rather than spreading their capital amongst a variety of stocks. Diversification, in their view, is for those who lack knowledge, and they certainly don't count themselves among the ignorant. Now, this can sometimes work, and if it does, you'll most certainly hear about it. Though more often, it does not pan out as these investors expected. It's a glass cannon strategy, and if you're watching this channel, then it's probably not for you. You probably treat your hard-earned money a little more carefully. Let's go over how diversification will help your portfolio building. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. In today's video, we're going to tackle diversification. Basically, it's like spreading your eggs across different kinds of baskets, or investments across different types of assets. So if one investment isn't doing great, others might be doing better and balance things out. It's all about lowering the risk of losing a lot of money if one area goes down. I'll explain why this is super important for keeping your investment portfolio steady and avoiding big losses. But first, I just want to show you this post from Reddit to really hammer home this point. This Redditor, a junior in college studying maths, recently inherited $800,000 from their grandmother who passed away 2 months ago. The person is fortunate to have their education paid for by their parents and doesn't have any immediate financial needs or debts. Therefore, they decided to invest, and that seemed to be a smart move. They looked at the company Intel and thought it was undervalued and decided to go all in on it. This didn't seem to be a smart move. What happened very shortly after was that Intel fell about 26% in one day. That's around $200,000 vanished from the inheritance in one day. Of course he's still holding, so it might come back, but it's not looking good. And this is where diversification comes in, especially in situations like this. What is diversification? Diversification means investing in a variety of assets like stocks, bonds, and real estate to reduce the overall risk of your investment portfolio. The idea is to spread out your investments so that if one asset loses value, others might still perform well, helping you to protect your overall investment. The main goal of diversification is to lower the chance of a big loss. By having different types of investments, you spread out the risk. This way, if one investment goes down, the impact on your total portfolio is lessened because other investments might still be doing well. The pie feature on Trading 212 makes it easy to build a diversified portfolio. Think of your investments as a pie with each slice representing a different asset like stocks or bonds, and you can customize the size of each slice to decide how much money goes into each investment, helping you spread your risk. The feature also automatically balances your investments, keeping your portfolio in line with your goals. Plus, it reinvests any new money or dividends according to your chosen slices, ensuring your portfolio stays diversified. Even with small amounts of money, you can still own a variety of assets by buying fractional shares. I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened a new account recently or planning to open an account, then here it is. DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thanks for your support and thanks to Trading 212 for sponsoring this video. How diversification works. When you invest your money, there are different types of risks you face and diversification helps to manage these risks. The first type is called unsystematic risk, which is the risk tied to a specific company or industry. For instance, imagine you put all your money into one company's stock. If that company experiences financial trouble and goes bankrupt, you could lose your entire investment. However, if you spread your money across multiple companies in different industries, the impact of one company's failure becomes less severe. That's because while one company might be struggling, others in different industries might be doing well, helping to balance out your losses. The second type of risk is known as systematic risk, which is the risk that affects the entire market. This happens during events like a recession or global crisis, where almost every investment is impacted in some way. Diversification can't completely protect you from this kind of risk, but it can help reduce its effect on your overall portfolio. By holding a mix of different assets such as stocks, bonds, and real estate, you create a situation where these assets might not all react the same way to the market event. For example, if the stock market takes a hit during a recession, bond prices might rise or remain stable, which can help soften the blow to your portfolio. In short, diversification works by spreading your investments across different areas to lower the chances of losing a significant amount of money. While it doesn't eliminate all risk, it helps manage it, making your overall investment experience more stable. Time diversification is also a key element of a well-diversified portfolio. This strategy, known as dollar cost averaging, involves investing a fixed amount of money at regular intervals such as monthly. By doing this, you buy more shares when the prices are low and fewer shares when the prices are high, which can help smooth out the impact of market volatility over time. Instead of trying to time the market perfectly, you invest consistently, reducing the risk of making poor decisions based on short-term market movements. When it comes to diversification, understanding correlation is really important. Correlation refers to how different investments move in relation to each other. The goal is to have a portfolio with assets that aren't closely correlated, meaning they don't all move in the same direction at the same time. For example, let's say you have investments in both stocks and bonds. If the stock market crashes, the value of your stocks might drop sharply. However, bond prices might increase or at least stay stable during this time. And because stocks and bonds often behave differently, having both in your portfolio can help offset some of the losses of the stock market. This means that while one part of your portfolio is going down, another part might be going up or staying steady, which helps balance things out. By ensuring that the different investments in your portfolio don't all react the same way to changes in the market, you can create a more stable investment experience. This way, your portfolio is less likely to experience drastic swings in value, making your investment journey smoother and less stressful. Types of diversification. Diversification by sector. Sector diversification means investing in companies from different parts of the economy, such as technology, healthcare, and utilities. Each sector can perform differently depending on various factors, and by spreading your investments across different sectors, you protect yourself from significant losses in any one area. For example, if you have all your investments in technology stocks and the tech industry faces a downturn, your portfolio might lose value. But if you also invest in healthcare or consumer goods, those sectors might still perform well and balance out your overall returns. Diversification by geography. Geographical diversification involves investing in companies from various countries and regions. Since economies around the world don't always move in the same direction, this strategy helps you lower your risk of being too dependent on any single country's economic performance. For example, if you only invest in companies from one country and that country's economy struggles, your investments might suffer. But if you invest globally, you can benefit from growth in other countries while reducing the impact of any single country's economic problems. Diversification by asset. Asset diversification means investing in different types of investments, like stocks, bonds, real estate, and cash. Each type of asset behaves differently under various market conditions, so having a mix can balance out your portfolio. For instance, stocks might be risky but offer high returns, while bonds are usually safer but provide lower returns. Real estate can offer steady income and potential growth, and by mixing these assets, you can protect your investments from large swings in any one type of asset. Think of asset diversification like a balanced meal with different food groups. Just as you need proteins, carbohydrates, and fats for a healthy diet, having a variety of asset types help keep your investment balanced and healthy, reducing the impact of downturns in any one area. Potential drawbacks. If you spread your investments too thin, you might end up with too many assets to manage effectively. This over-diversification can reduce the overall performance of your portfolio, as it may dilute your returns. Managing a highly diversified portfolio can become complex. You need to keep track of various investments and their performance, which can be challenging and time-consuming. In some cases, diversification might lead to lower short-term returns compared to putting all your money into a high-performing investment. However, the goal of diversification is to provide stability and reduce risk, which might be more valuable in the long run. Ultimately, diversification is a strategy to protect your investments by spreading them across different types of assets, sectors, and regions. This approach helps reduce risk and can lead to more stable returns over time, making your investment experience less volatile. Take a moment to review your investment portfolio and consider if it's well diversified. Think about incorporating various asset types, sectors, and geographical regions to balance your risk and potential returns. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!